Well, joining us to talk about the market day, we have David Ellison. He's portfolio manager at Hennessy Funds. Still with us is Tony Dwyer, chief market strategist at Canaccord Genuity. You know, Mike, when we saw this action fall, it was really on the trade headlines and maybe some discussion about the tariff rolling back and when it will happen or when it won't happen. I thought we were done with all of that, Mike.
I think we're in a substantive way done with it. I do think it was a little bit of a test of a market that was very extended and took the excuse to pull back on those headlines. We've been talking about how the market looks stretch on every metric, whether it was just technically or sentiment-wise. And there's kind of an easy way and a hard way to take care of that. The easy way is we go sideways, we rotate out of the extended stocks into stuff that's lagged. Some of that was happening today. The hard way is a really sharp, nasty pullback that we have to actually, reset some kind of a floor. So we don't know how this is going to go or if we continue to barrel higher from here. But to me, you've gone up on almost no incremental good news for days on end. So why does it have to be a genuinely substantive negative headline to take us down? It's a lot of trading mechanics and tactics right now.
And smaller caps doing well today.
Yeah.
I mean, which is...
And those are the laggard groups. So I think that was what we were seeing is Apple down 1-point-something% on nothing, except the fact that it was up a ton in a very short period of time, and stuff that hadn't participated it would seem like a rebalancing type day.
David, what's your take today in terms of the overall market sentiment, intraday pullbacks and ending roughly flat?
Well, I think Mike's made a lot of good points. I watched the market. Seems like it goes up every day. You've had some huge moves in Apple and Tesla that don't seem to have any sort of people just want to own those names. Disney's had a huge move. So sure, a pullback would make sense. I'm not sure what's going to create it, just like I didn't know what created the big rise this year so far. So I think at the end of the day, the banks that reported today are telling you that the consumer is fine, that loan demand is decent, that loan credit is good. So the economy is as good as it was 6 or 8 months ago, and it doesn't look like there's any deterioration. So the market doesn't have a reason to go down because of the economy or because of the consumer.
Tony, when you take a look at some of the read-throughs from some of the bank earnings today, when I look at Citigroup, it tells me that things globally look pretty good. The global consumer business was up 5% from last year. Am I reading too far into that, or does that give you any more insight into what we're seeing sort of beyond domestic banking here?
No, Courtney, I think it's corroborating what some of the OECD leading indicators, some of the market PMIs are saying globally, that you're seeing an inflection off of a historically weak period that was identifiable in the summertime of last year. But I think what we're trying to do is explain away what typically happens after you've had what we've categorized as the third mini recession of this cycle. We keep hearing that there's been no recession. It's been the longest economic expansion and bull market in history, but we've had pretty close to recession. This will be the third time in the end of 2018 into 2019. So that global slowdown is starting to stabilize and actually get a little bit better. And so information technology, banks, and industrials are supposed to outperform when you've already priced in a recession, which you did in the fourth quarter of 2018. So I hate to say it, but it's typically what you would expect. And I think one of the most incredible things I just read before we came on air was a Cleveland Fed study saying that their 10-year inflation expectation is at 1.7%. How do you think the Fed is going to raise rates if the inflation expectation 10 years from now is 1.7% when they want 2%? So I think there's a tailwind of the Fed and there's the tailwind of this global economic inflection from historically weak period.